Hi, I'm Evaldo Albuquerque, editor of FX Breakout Alert. Today I want to talk to you about the European debt crisis. After the last Greek bailout, everyone forgot about Europe. But in recent weeks, the debt crisis has made a comeback. Last week I wrote an article about Spain, and I told you why I expect Spain to be at the center stage of the next chapter of this debt crisis. One of the charts that I showed you last week was the chart of the Spanish stock market. As you can see here, in this recent week, this past week, stocks in Spain have made a new low, and it looks like the market is heading towards the previous low that happened in 2009 after the stock market crashed. So this gives you an idea of how bad things are in Spain. The stock market is anticipating that economic growth will be very weak in Spain. Well, and if the economy is not growing enough, there is a risk that the government will not collect a lot in tax revenues. So there is also a fear that the Spanish government will not be able to pay its bills because it's not collecting enough tax revenues. And you can see this fear in this chart, which shows the 10-year on the yield of 10-year bonds, 10 years Spanish bonds. So when the yields are rising, that means that the bond investors, those who are lending money to Spain, are requiring a higher interest rate because there is a higher risk of default. So when you see the yields rising, it means that bond investors fear that Spanish government will not be able to pay its bills. So you can see here that in this past week the yields have skyrocketed once again, and it seems that they're heading towards the previous high around 6 and 7%. So this is bad news for Spain, and it's also bad news for the euro. And this is how you can profit from this European debt crisis. One of the ways is to short the euro. You can see here that with the yields moving up in Spain, the euro has collapsed from 1.335 to 1.31. What's interesting now is that the euro is forming a head and shoulders, which is a bearish formation. You can see the left shoulder, the head, and the right shoulder. And this is what's known as the neckline. The head and shoulders indicate that the uptrend is turning into a downtrend. But we still don't have a head and shoulders. The head and shoulders is only complete when the price closes below the neckline. And that's why the euro is trading at a critical level. If the euro closes below the neckline, which is around 1.30, then according to the head and shoulders, the euro should move much lower. It should move at least to 1.265, which is the previous low. So this is one of the easiest way to profit from the European debt crisis. If the euro closes below the neckline, you should short the euro and short European currencies, because if that happens, it's very likely that the euro will move much lower. And that will also indicate that the European debt crisis is getting worse. So that's all I have for today. Thanks for watching.